Boy, Jeffrey, it's been a tough May. Just summarise what your investors and clients are telling you as we, stumble past the end of the month.
Well, our investors are largely hedged where they're looking to take a more defensive approach, but we're still looking for areas of opportunity, particularly in equity markets in areas like Asia, where the long-term growth outlook is positive, and also selectively in fixed income. For Europe, we're advising that clients take a selective approach, both in equities and in fixed income. And we think that after the current trade war-related fears, we think that we'll make fresh highs in European equities, and selectively we can see further opportunities in areas of fixed income as well.
All right, well, outline some of those for us, because if there's anything we could use today, it's a little bit of good news.
Well, if you take European equities, we think that the valuations look attractive. They are on average 13.5 times. The earnings outlook is solid at around 6%. And if you look at the comparison with fixed income, the yield gap is 2.9%. So you should get some technical support for equities over the course of the year. If you look beneath the indices, there's attractive sectors. For example, healthcare. That's a sector where, if you look back historically, earnings have been solid, both when rates have been rising, when there have been credit risks, and during recessions. So we're finding opportunities in that area. We're finding selective opportunities in the bank sector in Europe. And there we find that valuations on a selective basis look attractive, under 1 times price to book, with reasonable returns on equities. What we're really looking for is two things. Firstly, we're looking for the trade war to move to Europe and how Europe is impacted by that. And secondly, what we're looking to see is whether the recent growth upturn that we've seen in most of Europe can be sustained.
Jeffrey, though, how at risk are we for a recession in Europe or even in the United States in the next 1 to 2 years? And how would that impact those views?
Well, at the moment, we're expecting just over 1% GDP growth in Europe. And what we're looking at quite closely is the extent to which the trade war is going to impact on domestic sectors. So if you take Germany as an example, that economy has shown a slight uptick in the first quarter, but it's a fragile uptick because factory orders and industrial production are very closely correlated with the Chinese economy, which could be impacted by the trade war with the US. So were we to see a downturn in German capital expenditure, that could impact on the domestic sectors in Germany, which could take that economy into recession, not this year, but possibly next year.
Where do yields go in the scenario that you just outlined for Germany? I mean, we're already at minus 20 basis points there.
Well, we think in the short term, yields can go lower. We are in a short-term environment where growth forecasts are being downgraded. We're also in an environment where there's a flight to safety, and German bonds are perceived as safe havens. But if you take a longer-term view, the valuation is unattractive, and the ECB have finished their buying program, and they've been the main buyer of German bonds. So taking that medium-term view, we're cautious on German bonds, we're cautious on European sovereign bonds as an asset class, and we also anticipate negative impacts on corporate bonds, particularly investment-grade bonds in Europe looking forward. Just to put some numbers on that, at the moment, 75% of all European fixed income is trading with a yield of under 1%.